Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to help you make some money. My job is not just to entertain, but to educate, to teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. What an incredible snapback. This was a hideous week until today when the Dow shot up 1,207 points, breaking 50,000 for the first time ever. S&P jumped 1.97%. NASDAQ soared 2.18%. Led in part by companies that help build data centers. Yeah, well, it turned out those worked out. Now we've made it through the roller coaster of a week. Of course, we have to ask what's next. I mean, it's not like we can just say, hey, that was it, terrific. I don't usually start the game plan on Wednesday, but that's when we get the employment report this time. And it's kind of screwed up because of the government shutdown. And for the various job inputs we've seen, it looks like we'll have some real weakness. I like to take my cue from the stocks and the endless rallies in recession-proof names like PepsiCo or Procter & Gamble, J&J, Merck suggest maybe the economy's not that hot. Honestly, interest rates have been creeping up, so we actually do need a weak labor report for the stock market to keep going higher. A weak labor report would give the Federal Reserve later this year, not now, I'm not counting on any cuts from outgoing Chief Powell, more wiggle room to cut rates, something that would be a huge positive for housing, autos, and the construction sector, all of which are still hurting. Now, let's go back to Monday morning, and that's when we hear from Cleveland Cliffs talk about a company that's hurting. This is a steel company that's done better than if there were no tariffs, but not as well as Cramer fave Nucor, with a stock that's had a tremendous year. Cliffs needs more economic activity to do better. It's discouraging, but I'm not giving up on what lower interest rates could do for a steel maker that's not as good as Nucor. Now, there's been some incredible moves happening in the medical devices and distribution space this quarter. The once unsinkable Boston Scientific got clobbered this week because the competition got intense in their pulse field ablation business, which they had dominated. But on the other side, I told you that McKesson last week could be counted on for an upside surprise of gigantic proportions, and I have praised Cardinal Health to the moon multiple times. Well, McKesson and Cardinal Health both shot the lights out. These are classic drug middlemen. You can buy them anytime they're down, although the problem is they're almost never down. Well, the next device company that reports is called BD. Now, that's the old Becton Dickinson. It's streamlining the business, and I kind of really like the new company. I expect a very positive forecast. On Tuesday, we're back in heavy earnings rotation. We've got DuPont, Coca-Cola, CVS Health, AstraZeneca, Datadog, and S&P Global report. This is the new DuPont run by Lori Koch. She's done a terrific job. The stock's had a parabolic move, though, so we peeled a little off for the charitable trust. I hated to leave it, but wow, it's been, want to be greedy. PepsiCo stock went insane this week. It looks like the old PepsiCo with growth in snacks, except this time the growth occurred because they cut price. Coca-Cola doesn't have that nagging snack business. The snack business, well, that's been hurt by GLP-1s. But they've got a new CEO, and this is James Quincy's last quarter. He will be missed. CVS is now less of a drugstore than a managed care company, which is theirs is called Aetna. The stock got hammered not that long ago, and we learned that the government will barely raise reimbursement rates for Medicare Advantage plans this year. It was a disaster for the health insurers. The only one I want to own is CVS, which reports Tuesday morning. CEO David Joyner's done a terrific job, and I think it's a fascinating time to own the stock. They're the last real national drugstore chain now that Walgreens has been taken private, and the one-time giant Rite Aid has closed all of its stores. Now, how do you like that? Oh, also AstraZeneca, we want every drug stock. They're all working. Next, we have the tales of powerful AI companies destroying little guys, and this time it's Datadog and S&P Global. The dog is the kind of software as a service company that was once loved, not anymore. Stock's been nearly cut in half, but it still sells for less than 50 times earnings, but it's too expensive in this environment. There are cheap enterprise software stocks, just not this one. I'm going to go into the ones that are cheaper in a screen unemotional basis later in the show. Meanwhile, somehow the street has decided that S&P Global isn't worth as much as we thought, again, because of AI. Maybe the AI machines can design better indices and you don't have to pay S&P Global exorbitant fees to use them. I don't buy it, but that's how the stock has been trading, where, again, we're going to go into how these stocks, some stocks that have been destroyed from AI, but I don't want to own this one either. After the close of Robinhood reports, people are starting to get unnerved by how closely aligned this stock is with the price of Bitcoin. Even after today's dramatic rebound, Bitcoin still feels like it's lost its luster. The precipitous decline of the cryptocurrency occurring at the same time as a weakening dollar calls into question whether it's a real storehold of value or even a hedge against inflation. We know nothing. This volatile thing we used to think it could be a currency. That's obviously not going to happen. It's a great speculative asset, I guess, until it started plummeting. So Robinhood may be the repository of something that's become toxic and I think a lot less dependable. Wednesday, we have some possible blowouts. Let's start with Vertiv, which makes power and cooling equipment for the data center. Could be a monster quarter. But will anyone care? Depends on the mood of the day, I guess. Here's another one that's blessed. McDonald's. Sure, they've been hurt by beef. It ain't Wingstop, but the value proposition is back, and I think it works. By the way, the president's just now cutting tariffs on Argentina. That could, on Argentinian beef, I think that could be positive for that, and for Texas Roadhouse, by the way. Maybe we can find out what's the matter with one-time fan fave T-Mobile, with a stock that's fallen off K2. This thing acts, or at least it trades like it's got slower growth than Verizon. How's that possible? We get earnings, an analyst presentation, and hopefully some answers. Wednesday night, we find out how Cisco stock's been doing. The stock's been soaring. I don't know. We have to find out whether this is a company that has got less software and more hardware. The old days, I used to hope it had more software and less hardware. But it's still a sizable position for the Chapel Trust. You know what the market doesn't like? How about AppLovin, which is a former market darling from the year of magical investing? Not so magical now that Google's decided to crowd into that space. Plenty of earnings Thursday, but I want to start with what could be an explosive analyst meeting from Federal Express. Have you seen this thing run? CEO Raj Subramanian is one of my heroes. He took the reins from the late founder, Fred Smith, and he made him proud. What an extraordinary improvement in service while cutting out costs. Billions of dollars. Not easily done. I mentioned how Robinhood may just be a proxy for Bitcoin just now. What does that say about Coinbase now that the major cryptocurrencies are everywhere? I got to tell you, I don't want to touch this one. Then there are two contrasting stocks that make terrific bookends for this segment, DraftKings and Agnico Eagle. DraftKings is stymied by a lack of consolidation in an industry that needs California, Florida, and Texas to change their minds and allow gambling. I'm beginning to believe that unless they find new people who can help them open accounts, the stock might falter. It's so low now, though, that it reflects no good and a whole lot of bad. Agnico Eagle, on the other hand, reflects all the good in the world and then some as the second largest gold miner on Earth. This gold stock is so shiny you need sunglasses just to look at it. Here's my advice. If you don't own any gold, bite the bullet and get some of this stock in. Then wait for it to pull back. It will, but always own some gold, especially after we saw that Bitcoin isn't worth its weight in the precious metal or perhaps maybe even anything. Finally, Friday, we're going to hear from Moderna, one of the hottest stocks in the market this year, as people are buzzing about their personal cancer vaccines. All I can say is I hope they happen because, you know what, we've been expecting these for, well, how about since the time it came public 7 years ago? All right, what a week. The mighty Dow crosses 50,000, and to think that the Dow was at 1,000 when I first walked down this street right over here 44 years ago. A lot of money's been made, but only for the persistent and the patient. Oh, and I neglected to mention that you won't see fast money or mad money in the next 2 weeks. In our place will be coverage of the Milan Cortina Olympic Games. Go Team USA, and we'll see you on the 23rd. Here's the bottom line. There's a lot going on next week, but the most important thing is, believe it or not, the Labor Department's non-farm payroll report on Wednesday. If that comes in soft, it means the Fed can keep cutting rates, and that's great news for the stock market itself. Let's take questions. Let's go to Ian in North Carolina. Ian.
Happy Friday, Jimbo. How's the weekend looking?
It'll be fine. How about you? You got the game.
Yeah,
you know, the game
here.
matters.
It's all good.
Yep. Game matters.
Well, hey, I got just a simple buy, sell, or hold on Tempus AI, ticker TEM.
Well, you know, we're not recommending stocks that are losing a lot of money here just because the year of magical investing made a return, and I think you got a little reprieve, and it's going to go back down again. Let's go to Matt in Arizona. Matt.
Jim, with magical investing over, is a Comfort Technology now in the clear?
Well, that stock has had such a run. You know what? I'll tell you the truth. I'd rather own Vertiv going in ahead of the quarter than this stock, which is now up 31% already this year and up at a new high just this very day. All right, look, there's a lot going on next week, but keep your eye on the non-farm labor report in particular because rates have to come down. They've been going higher. On Mad Money tonight, all the big tech names except NVIDIA have reported. So I'm taking you through the numbers and giving you my take on the cohort. Then the Dow closed above 50,000 today, but there are plenty of stocks not taking part in that rally. I'm looking at the enterprise software stocks and trying to identify just what's going wrong here. And this week, two major energy players, Devon and Coterra, announced plans to merge. I'm learning all about this big merger and what we can expect from the new company when I sit down with the CEO of Coterra. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Over the last 2 weeks, we've heard from 6 of the 7 mega cap tech stocks that we formerly called Magnificent 7. We don't do that anymore here. We don't because they no longer feel like a coherent group, and they certainly don't trade that way. Some of them are just terrible, some of them are okay, and a couple are good. But this is a big but here. The Mag 7 still account for roughly a third of the S&P 500. They're still incredibly important, which is why tonight I'm going to give you a roundup on the ones we've seen so far, which is everybody except NVIDIA. On Wednesday of last week, we got results from Meta, Microsoft, and Tesla. One of these days where I sincerely believe that big tech is trying to give me a heart attack. Why else would they schedule the reports all at the same time? Let's take them one by one. Starting with Meta, which initially got a lot of love, rallying 10% the next day. Makes sense. Mark Zuckerberg delivered a huge top and bottom line beat. More importantly, he explained exactly how Meta's AI investments are already helping to make their core advertising businesses more profitable. I like that. Of course, he still projected $115 to $135 billion of capital expenditures for 2026. But that goes down easier with an explanation, and the guidance for the current quarter was excellent. Basically, Meta gave us enough reason to believe that its investments are worth it, so it got a positive reaction at first. Now, since then, the stock has slid lower in 5 out of 6 sessions, including a 1.3% decline in today's otherwise positive tape. That was surprising to me. At this point, Meta's now erased all of its gains from last Thursday and then some. But as I see it, that just means you're getting the quarter for free. Remember, we enthusiastically own this one for the charitable trust. It actually mystifies me. I just think this one's a buy. That same night, we heard from Microsoft, and the market was not amused. Mr. Softy's Azure cloud unit saw a deceleration in its revenue growth, in part because they were sending essential NVIDIA chips to other parts of the business, including Copilot, so they couldn't keep up with Azure demand. Meanwhile, Copilot doesn't seem to have much demand. They boasted that their AI platform has 15 million paid users, which sounded pretty pitiful to me given the way that they crammed this thing into every aspect of Microsoft Office. Now, it didn't help that Microsoft is still spending a fortune on AI infrastructure, or that 45% of the remaining performance obligations, meaning bookings, came from OpenAI. I'm not too worried about OpenAI, but to many on Wall Street, it's no longer seen as a reliable customer. And that's why Microsoft stock fell nearly 10% the next day, and it's kept falling until today when it finally got a slight bounce. I think they need to explain their story better, although with the stock now at 24 times earnings, it certainly seems more enticing. Happy to have them on the show explain what's going on here. It would certainly help. That same night, we got results from Tesla, which actually beat numbers, but nobody cares about the numbers here, as electric vehicles are the past. And according to CEO Elon Musk, the future of this company comes down to cybercabs and humanoid robots. Stock fell more than 3% the next day, maybe because their capital expenditures budget was higher than expected, or maybe people wanted more details on the new businesses. At this point, I think Musk's acolytes might be more excited about SpaceX, which is planning to come public later this year. Last Thursday, Apple reported a magnificent quarter with blowout iPhone sales and staggeringly good numbers from China, which had previously been one of their worst regions. Apple also offered strong gross margin guidance for the current quarter, which suggested that they aren't getting killed by high memory prices, at least not yet. While there was some initial hand-wringing about what might happen beyond this quarter, buyers eventually shook off that concern and were able to send the stock higher. After barely moving last Friday, Apple's rallied nicely. Now it's now up almost 8% since the quarter. Doesn't hurt that they're avoided spending hundreds of billions of dollars on data centers by simply partnering with Google's Gemini on AI. As I always said, own Apple, don't trade it. That's what we do for the Travel Trust. This week, two members of the Mag 7 reported, Alphabet on Wednesday night and Amazon last night. And with both of these, Wall Street focused on their massive CapEx forecast. Sell. That's what they said. Alphabet plans to spend $175 to $185 billion when the analysts expected just $116.5 billion. Then Amazon said, hold my beer, and projected $200 billion in CapEx this year when Wall Street was only looking for $146.6 billion. Initially, it looked like Alphabet might get away with its huge CapEx forecast as they blew away the numbers, and they're winning the AI race on the consumer side. But eventually, the stock faced some selling pressure, falling almost 3% over the past couple days. Keep in mind, though, Alphabet came in hot. This was the best performing Mag 7 stock last year. I think it was simply due for a breather, frankly. This is a house of great businesses. Google, Google Cloud, Gemini, YouTube, Waymo. They're the best at everything they do. I see it in Alphabet's in the catbird seat. As for Amazon, I believe in management's ability to deliver, but you need a certain level of faith if you're planning to own this one. That $200 billion CapEx number was shocking, as the company invests in everything from AI infrastructure to its retail operations to low Earth orbit satellites that it can use to compete against Starlink. It totally overshadowed positives from the quarter, including strong growth from Amazon Web Services. But away from that $200 billion CapEx burden, the stock also sold off because their operating income guidance for the current quarter came in substantially worse than expected. I think their investments will pay off eventually, but in the meantime, it's obviously going to hurt. So again, do you trust Amazon to come out of the other side of this investment cycle in a better position with more earnings power? I do, which is why we own it for the CNBC Investing Club. But not everyone agrees, so I wasn't shocked to see the stock down more than 5% today. As a matter of fact, I thought it would be down more than that. I'm not going to pound the table for the stock of Amazon here. It's too hard. I am saying that I'm willing to hold on to it because I trust CEO Andy Jassy to execute here. But I know that's a leap of faith that's too hard for many of you to take. It's a big change to go from a solid growth company to one that may have to take down a lot of debt to grow faster. Not what many of you signed on for, hard stock to own. That leaves us with NVIDIA, which hasn't reported yet. But when you see all these mega-cap tech companies budgeting insane amounts of money for capital expenditures, you know a lot of that's going to NVIDIA. Sure, some will go to Broadcom and Marvell Tech, but you better believe NVIDIA is getting a big cut of it. Maybe that's why the stock soared nearly 8% today, its best session since April of last year, and many had just begun to give up on it. Here's the bottom line. If you're in from 6 of the formerly magnificent 7, I reiterate that the group is no longer a monolith. Some are doing a lot better than others. If you've seen the movie, not everybody makes it to the end, like Steve McQueen or Yul Brynner. Based on what we've heard so far, I'm more sanguine about Alphabet. I like Meta, and I reiterate that you should own, not trade, the stocks of both Apple and NVIDIA. Mad Money is back after the break.
Coming up, have a handful of gems been lost in the sauce of the sudden software sell-off? Cramer is searching the scrap heap to see what you should be buying back into. Next.
If you own any software stocks, the last couple of weeks have been a hard show for your portfolio. Look at the iShares Expanded Tech Software Sector ETF. That's the big one. It's down over 30% from its September highs and 15% just in the last week and a half. Like I've told you before, a lot of this comes down to AI worries. These generative AI platforms are great at writing code, making it easier for big companies to develop their own software in-house. And at the same time, AI helps businesses do more with fewer employees, which is a problem for enterprise software firms that charge per user. Lately, we've seen a bunch of big announcements from Anthropic, the company behind Claude, which keeps rolling out AI tools that can potentially replace all sorts of non-revenue generating jobs. And that's caused Wall Street to give up on the enterprise software cohort en masse. Even when these companies report good quarters, and most of them have been good, well, their stocks, they still go lower. But this sell-off has gotten so savage that in some cases, I think the proverbial babies are finally, and I've been waiting for this, finally being thrown out with the bathwater because I don't necessarily like all these companies. That's why tonight I want to help you identify some buying opportunities. Software stocks that have either gotten too low or never should have been thrown out in the first place. We ran a screen looking for non-small cap software and tech services companies with stocks that are at least down 25% from their 52-week highs and that now trade at a discount to the S&P 500, despite having above-market earnings growth rates. We also screened out anything unprofitable. Of the 176 software and tech services stock sector, only 23 of them passed these tests. Now, that's a nice winnowing out. Let's go through some of my favorites since this screen. Let's start with Box and document storage and collaboration software play with a stock that's down 36% from its high. CEO Aaron Levy was on CNBC earlier this week, and I thought he gave a great rebuttal to the idea that AI will make enterprise customers completely abandon third-party software. You can watch that on CNBC.com, by the way. Box is expected to grow its earnings at a 15% clip this year, and it sells for just 16 times this year's earnings estimates. That's pretty darn cheap, especially since Box hasn't had any trouble meeting the estimates. Now, a little more controversial. Let's talk Atlassian, Simple Team, another collaboration software firm mainly aimed at software developers. Because they make software for coders and coding jobs are under threat from AI, the stock's been obliterated, down over 70% from its 52-week high. But when Atlassian reported last night, it delivered a terrific beat and raise quarter. It's just that Wall Street didn't care as the analysts nitpicked the company's R&D spending, so the stock tumbled another 4% today. At this point, though, Atlassian is expected to put up nearly 30% earnings growth this year. Yet the stock sells for just 20 times its 2026 earnings estimates. Look, it's absurdly cheap unless you think the business is about to fall off a cliff, and some people think that. I do think AI is a real threat here, but my gut feeling says it's a long-term threat, not something immediate. Third, there's HubSpot. This is controversial. It's a marketing, sales, and customer service software play with a stock that's down 74% from its high, even worse than Atlassian. It's considered to be a mini Salesforce. This company's on track to put up 20% earnings growth this year, and its stock trades at 20 times this year's numbers. Sure seems cheap to me. That said, HubSpot reports next Wednesday, and given the way these stocks have been trading, I think maybe you wait for the quarter and then do some buying if it sells off on good numbers, which we've seen time and again over and over this earnings season. Keep in mind, HubSpot has not been one of my favorites, but it pops up on our screen as very cheap, and I can't deny the screen identified it. Then there's Workday. You've seen them on our show a lot. It makes software for human capital management and corporate finance. It's a name brand company. The stock's fallen 43% from its highs to the point where it now trades at less than 15 times this year's earnings estimates, despite the analysts expecting them to have an 18% growth rate. What else? Okay, here's one that I'm happy to buy. It's Intuit, the company behind TurboTax and QuickBooks, with a stock that's down more than 45% from its high, trading at just around 19 times this year's earnings estimates, one of the great growth stocks of our era. To me, this health doesn't make much sense. Much of TurboTax is geared toward the consumer. The AI threat for that is therefore minimal. The rest of their software is geared to small and medium-sized business, the kind of companies really can't afford to develop their own software internally, even with the help of AI. I think this one's a baby that's been thrown out with the bathwater, and I'd be a buyer right here, right now. Well, those are my top 5 that passed the strict screen we ran to identify undervalued software stocks. But if you're willing to step a little outside these strict parameters, I've got 5 more that are starting to look enticing. Well, first, there is Salesforce, which we own for the Travel Trust. It barely missed our final screen list because it's growing earnings at a 12% clip this year, a little slower than the S&P in the aggregate. But, man, Salesforce is down 43% from its 52-week high, selling for just 14 times this year's earnings estimates, literally its lowest price-to-earnings multiple in history, including 2008, including the Great Recession. I think it's near a bottom. ServiceNow, which we had on the show last week, is also starting to look good, down over 50% from its high. They're expected to grow earnings by 19% this year, and though you'd have to still pay a slight premium with the stock selling for nearly 24 times this year's numbers, that's down from nearly 70 times forward earnings at the end of 2024. ServiceNow also announced a big buyback last week, including a $2 billion accelerated buyback, so you have to assume that they'll be right there buying along with you. Beyond that, I like 3 beaten-down cybersecurity names because I think security is important enough that most companies won't want to experiment with having AI make their own in-house replacements. First is Okta, and they didn't initially make the list because it's only expected to have 7% earnings growth this year. It's kind of unusual for this good company. But not long ago, CEO Todd McKinnon told me that Okta has a huge opportunity securing thousands, if not millions, of AI agents that are being created within the enterprise, and that it resonated with me, frankly. With the stock selling for just 23 times this year's earnings, it's probably worth nibbling at. Now, here's 2 that I just say, time to buy. We own Palo Alto Networks and CrowdStrike for the Travel Trust. We're sticking with them, even though these stocks are down 29 and 30% from their highs, respectively. These are the top two consolidators in the cybersecurity space, and they're so important to their customers that I see little or no possibility of it or threat of AI disruption. I think that they could be working hand in hand with AI. If anything, AI means more business for them, though, because this new technology gives bad actors powerful tools to hack into your networks. You almost never get a chance to buy Palo Alto or CrowdStrike at deep discounts. So if you don't own them already, I would pounce. Of all the stocks mentioned, these two are my favorites because Anthropic cannot possibly duplicate or even improve on what they have built. We bought some CrowdStrike into this dip because the decline is way out of whack with the company's prospects. We know that it might not bottom here, but sometimes you have to take a bit of risk with high-quality franchises when stocks are low. Here's the bottom line. Yes, AI will hurt many enterprise software companies, but when you look at how much these stocks have already come down, I think there are real buying opportunities here, as long as you stick with high-quality merchandise, especially cybersecurity stocks that simply shouldn't be trading with the rest of the group like they are now. Let's go to Ahab in New York. Ahab.
Hey, Jim, how are you? I have a quick question. I took a position on Oracle since it was 288. As you know now, it's below 50%. My question, should I sell or hold?
Well, Oracle, I don't like what they're doing to their balance sheet, and I always like companies with good balance sheets. And I think that this one is therefore not investable right now. I think it can bounce, and if it does bounce, I think you should sell it. Let's go to Brian in New York. Brian.
Jimbo, am I overreacting here? Is Unity Software is down over 50%. Is management just not able to execute, or is AI really going to take over the business? You think that?
I think that these guys are a candidate to be hurt by it. But you know what? We should just have them on and make the decision like that, because let's hear them out after the decline that this stock has had. AI will hurt a lot of enterprise software stocks. There is no doubt about that. But when you consider how much they've come down already, you know what? You got to take a look at least among the rubble and see what might be worth owning. Now, much more Mad Money ahead, including my exclusive with Coterra, off the news of the company's merger with Devon Energy. Then, even after a hugely positive day, this week saw a lot of pockets of weakness. I'm running through them and detailing how you can prepare for next week. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Earlier this week, we learned that Devon Energy is merging with Coterra, an all-stock deal worth about $21.5 billion. That would make the combined company the fourth largest independent energy producer in America. It'll be one of the largest operators in the Delaware Basin. That's an oil-rich region of the Permian that we like so much. This is a very big deal. So let's take a closer look with Tom Jordan. He's the chairman, president, and CEO of Coterra, to learn more about what's happening here. Mr. Jordan, welcome back to Mad Money.
Hi, Jim. Thanks for having me.
All right. So tell me, Tom, why do you have to do it? Because, you've been running the company. You got a merged company with Cabot. Been going along okay. Why now? Why do this?
Well, look, both companies are doing exceedingly well. We've always had great respect for Devon, their assets, their people, their organization, and I think it's been mutual. And, Jim, this is a story that kind of tells itself. When you look at the overlap of the assets, the diversity that we'll have of revenue, and also the strength of both organizations, it really is a story that tells itself. This will be one of the strongest companies in our sector, very well positioned and built to compete with a whole new class of peer companies.
So you've got, it looks like you'll be top, let's say top one or top two or three, Anadarko, Eagleford, Marcellus, Rockies, and of course we've got the Permian. What's the plan? Will you keep all those areas, or is it time just to really focus on the Permian, which is terrific?
Well, first, let me tell you that Clay Gaspar will be CEO. I'll be chairman of the board. Sorry. So certainly Clay's the one that carries this torch. But, at the very beginning, we're going to need to go through just a portfolio optimization. And that can mean a number of things, including looking at capital allocation, looking at do we have the right assets. I mean, all of that's work to be done. And we need to get our new board together. We need to have conversations. But, Clay's the right person for the job, and he'll do a fantastic job just getting this company on its feet day one.
Okay, so tell me where things are in the industry. I mentioned that because I've been spending an awful lot of time with the people who run these big data centers in Mag 7. And it's very clear, as much as they would like very much, to be able to make it so they could make it all with nuclear, make it all with solar, make it all with wind, make it all with hydro. It's really natural gas, and they just don't like to talk about, but it's true. Where do you think natural gas is in the pecking order in this country of energy?
Top of the stack, Jim. We need all. It's not one source of energy is not in competition with another, and they all have different attributes. But when it comes to things like electrical power generation, particularly for data centers that need to run 24/7, that energy needs to be reliable and dispatchable. And by that I mean, regardless of weather, it needs to be able to generate electricity on demand under all conditions. And natural gas is a clear winner in that set of criteria. And then one other thing I'll say about the new company, Jim, a lot of these counterparties are looking for very healthy investment grade suppliers. And we announced on Monday, all three credit rating agencies have us on positive watch. And with our balance sheet and our financial wherewithal, we are really sitting in a good position to satisfy that demand with counterparties that want investment grade counterparties.
Well, I actually thought of you when I know that some of these companies are looking to buy. They're literally looking to buy a natural gas company. But I think now you're too large, and you're able to dictate some good terms versus some of the smaller guys.
Well, it's going to be a powerful company. We're putting this company together to compete. It's going to be something that will be a force to be reckoned with. Jim, you know our industry well. In many respects, companies like ours are technology companies that happen to produce oil and gas. The amount of technology that we throw at these problems is just stunning, and the advancements we've made, and that's the beauty of this combination. Not only do our assets overlap, but both companies have taken different approaches and solved different problems technology-wise, and bringing them together is going to be a powerful leveraging combination. Both teams are excited about this, and this company is going to be built to compete.
Hey, Tom, tell me about natural gas in general. What the heck happened that we could still, as a major country and the biggest natural gas country in the world, still have a natural gas spike on a cold snap, go to $5, $6, get everybody worried? What is it about the system that made that happen?
Well, we need more infrastructure, Jim. There are still bottlenecks, and you have disconnects between our ability to move the product to the customer based on where the demand is. And in some sense, we're a broken record here, but it's a record that needs to be heard. We need infrastructure. If you look at the amount of pipelines that have been built in the United States over the last 20 or 30 years, it's criminally low compared to the increase in production. So, hopefully some people in Washington are hearing that. Some people in states are hearing that. We're ready as an industry to supply the gas. We need very productive, efficient pathways to get it to our customers.
Are you willing? I've just got a minute left. I don't know whether I hope I still get to interview you, but are you willing to go to Washington and tell that story? Because we need someone who's level-headed and understands the environment, is not trying to do anything that's cowboy, whatever, to explain how natural gas really is great and how we just need more infrastructure and make it so that we're a much stronger country.
Well, it's an honor to be able to represent our industry in any venue where there are reasonable people that want to engage in conversation. We love engaging with our critics because we think we've got a persuasive argument, and our industry is going to be there to supply, put America in the catbird seat in a global competition. Well,
I want to congratulate you for all the great things that you've done. You've been an amazing steward of shareholders. And when it came to the idea that, you got to combine and do well for the shareholders even better than you're doing, you went and did it. You didn't have to. Could have stayed independent, right? Could have stayed independent, but you chose not to.
It's the right move for our shareholders. It's the right move for our company. And, I'll just say one more time, Clay's the right leader for this organization. So I'll be honored to be chairman of the board, highly engaged. But from a board standpoint, Clay will be running the company.
Fair enough. Tom Jordan, terrific guy. I hope to get to see you again, sir, because you've been Such a great person to come on the show. CEO and chairman of Coterra Energy, soon to be chairman of the New Devon. Thank you so much.
Thank you, Jim.
Nab, I'm going to be back here for the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's time for the lightning round. Question about let's talk to by social just be on cold cards ahead of time. My step bears the graphics of the body. You play the sound. And then the lightning round is over. Are you ready, Ski Dad? Time for the lightning round. Let's start with Ron. I'm not just Ron.
Thanks, Jim, for taking my call.
Of course.
The stock is Klarna, symbol KLAR.
I tell you the truth, I would rather see you in a firm. I interviewed Max Levchin today. I know the stock is going out of favor, but the numbers are good, and that's the one I would be in. Let's go to Sam in Pennsylvania. Sam.
Jim, listen, we got an aging global fleet of aircraft, and the backlog at Boeing is not getting any better. So that's where TAD Technologies is benefiting right now. So I'm curious what you think about
that is a really interesting stock. I know it's moved up a lot, and I like Halmet. I think you're in a good one, though, if you're in TAD. I think that is exactly where to be. We want to be. We're in Honeywell and in Boeing for the Chapel Trust. Let's go to Alaya in Michigan. Alaya.
Hi, Jim. Thanks for taking my call. I just wanted to get an opinion. I wanted to get your opinion on UiPath.
You know, I'm not like UiPath because this whole idea about, that there's these things robotic things that will get rid of the humdrum and the prosaic. It just never struck me as something I wanted to be in. It's finally got making some money, but it's still too expensive a stock. Let's go to John in Pennsylvania. John.
Mr. Cramer, thanks for taking my call.
Hey,
I'm a club member.
Excellent.
Have a great birthday next week, too.
Thank you.
Listen, I feel like I own the deed to the House of Pain and Toast.
Yeah, you know what? Boy, that stock has just really come down. They've got a great device, but you know what? That's not enough. And I've always been suspicious of it because I don't think you can trade back and forth, but it's got a good device, but a device does not make a great stock. Let's go to James in Louisiana. James.
Booyah, baby.
Booyah.
I want to know your thoughts about the first publicly traded company with a federal bank charter in the digital asset sector.
Well, I think if you went digital assets, I think you should just go buy Bitcoin. That's the only thing I'm going to recommend in that whole group anymore. Just go buy. You want Bitcoin? Buy Bitcoin. Let's go to Josh in New Jersey. Josh.
Hi, Jim. My father has never steered me wrong before, but he steered me wrong with going with Butterfly Network.
You know, the ultrasound, I don't know. It's too competitive. Just tell them it's a very competitive market. And I don't want to be in that part of the medical device group. Even GE Healthcare reported a pretty good number. And it went up for about 10 seconds, and then it went right back down. Too hard for this guy. Just too hard. Let's go to Kurt in Ohio. Kurt.
Hello, Jim. Good evening, sir.
Good evening.
My question is regarding Enbridge.
I love Enbridge, but hit a 52-week high today. Reports next week. I still think the yield's great. It's a really good company. I'm not going to push something at a 52-week high before it reports. There'll be people who don't like it, and that's when you're going to want to buy it after they sell it. Let's go to James in Mississippi. James.
Booyah, Ski Daddy.
Wow, you came to play. What's happening?
Looking at a stock, I've got this company. I've had it for a number of years. Harmony Gold Mining.
Harmony's good. Look, I'm an Agnico guy, and you see when I have Agnico Eagle, what a solid stock that is. What a great story that is. That's the one I want you to be in. Let's go to Ross in Maryland. Ross.
Hi, how are you? It's an honor to speak with you, Jim.
Thank you.
Very long-time listener. In order to diversify my tech-heavy portfolio, I was thinking about a stock that I've owned for a long time, Dow Chemical.
Okay, look, Dow still needs the Chinese buyers to come back. It's had a really nice bounce because people wanted to buy the cyclicals. I actually be a trimmer of Dow right here after a very brutal run, not a buyer. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, After a rough week on Wall Street, Cramer's investigating the most likely culprits and telling you how to help your portfolio rally. Next.
Jim Cramer, the diehard of the dollar.
Hey, Jimmy, love the show. My 5-year-old grandson loves to watch your show.
I have to thank you for making us money when it's there to be made.
Our world is a better place with you in it.
Now that we've come out of the other side of the brutal sell-off, with the averages soaring today, it's worth looking back on this week, figuring out what the heck happened. What was going on when stocks were melting down? I think you have to divide the sellers into a couple camps to make sense of anything. First, there was a tremendous amount of selling in everything thanks to the collapse of Bitcoin earlier this week. When it rebounded today, did you notice stocks came right back? When you have some asset that's so big, so sprawling, and it goes down, you always find that there are people on margin, borrowed money, who don't want to sell that asset. So what do? They sell what they can to meet their margin calls, like the S&P futures. That always creates confusion. What do the S&P futures have to do with Bitcoin? Simple. They're a ready source of funds for people who suddenly need funds, like the owners of Bitcoin. And why did Bitcoin go down so much? I think people who watched the dollar weaken at the same time as Bitcoin were surprised. I think it caused a big loss of faith in crypto. Wasn't it supposed to be a store of wealth that you could be protected from if currency gets devalued? A weaker dollar should have made it strong. It didn't. Well, we now know that gold was a storehold of value and is a much better safe haven. And by the way, that's where the money went. I think the money's going to keep going to gold. At this point, though, it looks like Bitcoin might have bottomed, thanks to rumors that President Trump will put money in a strategic Bitcoin reserve. I'm not sure why we need one, but just the chatter alone that this could happen bailed out a lot of crypto investors, including a company called Strategy, which has the largest agglomeration of Bitcoin in the world. Strategy reported yesterday and talked about our crypto president. Crypto's been bouncing ever since, and it's taken a lot of pressure off the stock market. They are terrific cheerleaders. The faithful lap it up. Second camp of sellers, those who believe that the AI companies will come after every enterprise software stock. Now, this camp is acting out of fear of Anthropic, the business-to-business AI service. It's developing programs that a lot of people feel are better than Adobe, Salesforce, Workday, Atlassian, ServiceNow, anything that those guys have to offer. As you heard earlier, though, I think some of these declines are overdone. Sellers don't care. They just want to get out now. Third camp of sellers, those who have given up on the Magnificent Seven altogether. Close viewers know I have given up on the name of the Magnificent Seven because these stocks were once considered solid performers, but are now just disliked en masse. Their stocks have they've been no picnic to own. I say stop thinking of them as a group, though. I know that for the charitable trust, we want to buy more Alphabet as soon as we can, and we've been telling club members this because that's the one that really seems to be having a buyable dip. I like the decline in Meta, but because the stock is overdone, but I'm not going to pound the table on it. Apple and Nvidia remain the two stocks that I say own, don't trade. The only two in the entire market that are blessed like that. Amazon, after today, it's become a work in progress. I can see why people are selling these stocks. They're falling behind much of the market. So they're losers instead of winners. Finally, there were sellers who said they only want to own companies that make things and do stuff and have reasonable price-to-earnings multiples, dividends, buybacks. Well, most of the tech stocks do not fit that pattern. You must know that I am in this final camp. I pulled in my horns for the charitable trust. I don't want to own a lot of stocks that are expensive or make no money or can't be justified by typical prosaic valuations. That's why the charitable trust portfolio looks like it does. I think that what matters here is value, and you have to have some value in your portfolio. To have value, you need profit. So you have a couple of unprofitable or expensive companies in your portfolio, that's okay. As I say in How to Make Money in Any Market, I am okay with owning some speculative stocks. But if they make up a big chunk of your portfolio, you are chasing too much risk and not enough reward. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you next time.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC or its parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.